Morning, everyone. My name is Dylan Cox. I'm the head of private markets research at PitchBook. I'm joined by a very esteemed panel this morning, and since we've already done introductions, we'll jump right into it. Ekta, globally, VC deal value is on track to pace about 10% behind last year's number, which, if that holds true by the end of Q4, would be the third consecutive year of decline in VC investment. What do you make of that trend? What are the key factors driving it? And also, what would it take to turn that around? What will reignite investors' appetite in this asset class?
Thank you for that question. Hello, everyone. You combine like whole session into one question here. Lot of factors, of course, we all know the state of macros, so I would not get into details. We all understand, we've been discussing that. Focusing on VC, we have seen a lot of bubbling that has happened, and combined with a lot of turmoil globally, I wouldn't use the word recession, I wouldn't use the word anything extreme, but I would definitely mention the shift in the perception of VC ecosystem, how we have seen the growth versus how we are seeing. So definitely there is decline. There is decline in the distributions to LPs as well. So that is trickling down to every level. I would just focus one more thing, focusing on the, we have historically been very excited about the growth of the VCs. I would say along with growth, we want to focus on profitable growth now.
Jörg, anything to add there?
Yeah, sure. First of all, I would like to distinguish between the short effects we've seen, an abnormality in the market due to in 2021 we had the absolute peak. Then we had the crash coming with this. We had a very long period of low and negative interest rates. Then we had Russia, Ukraine. We have the situation. We have very many geopolitical crises, and so the market have come down. I think in the long run, there is no alternative other than investing in technologies to overcome the challenges we face in the current world. Think about healthcare, life science. Think about security. Think about transportation. Think about education. Everything, climate, environment, all those challenges we're facing in the current world, we can only overcome with technology. And so I think in the long run, technology is really the asset class which will succeed and will show a very positive performance. We certainly have challenges in the short term. When we look at the exit markets, we need liquidity in the market. We certainly, the venture capital market is certainly one of the most transparent markets. Once we have more transparency and once we have more liquidity in the market, this asset class will become stronger and will be the preeminent asset class.
And Ollie, a variation of that question, the prior panel mentioned that the likes of Tiger Global and Andreessen and other very large global venture investors have pulled back from a lot of their markets, or maybe aren't driving up valuations to the extent that they were in, say, 2021. Is that the main reason that deal value is falling, or that it seems like VC is in a bit of a lull, or are there other factors at play?
I would say there are several factors, including but not limited to also, it's after all, I would say economic correction or market correction as we speak. After all, any rapid growth in the, let's say, economy or in certain asset class, it will drive the valuation up. And obviously, after some times, a correction will come. So it's something I would say pretty normal. It doesn't mean that this asset class is not really an attractive asset class anymore. I would say that it's a cycle. And we've seen the cycle throughout the past years, and it will continue to happen. And also, let's not forget that we've seen so many, let's say, amateur investors suddenly just stepped into these sectors when it was lucrative, as well as we've seen, let's say, hedge funds, private equities, due to the scarcity of, let's say, large deal flow, they started to invest also in early stages. So all of that contributed to that.
And Ivan, do you agree with the rest of the panel? Is that what's causing the decline? And if not,
Yeah, I mean, I think everyone on the panel sort of covered most of the key points. I think what's promising is that the IPO markets are slowly starting to open up. If we look at some of the recent trading performances of some of the tech companies that have gone public, like Reddit and Klaviyo, for example, their trading performance have been pretty strong. And the private markets always lag the public markets by about 9 to sort of 12 months. So I think this could filter over into the private markets in the coming year. So I think obviously venture investing is a very cyclical sort of type of investing, as with any sort of investing. So we can definitely expect more sort of momentum in the coming year.
I want to turn and ask about more of a sector or vertical focus that each of you may have. There's obviously a lot of talk about AI for obvious reasons. There will be panels dedicated to AI later on today. But outside of AI, what sectors or verticals are getting you excited? Where are you investing in and seeing opportunity? Ivan, maybe we'll stay with you.
Yeah, sure. So we're a sector-specific fund. We only focused on the B2B space within fintech or financial services, and this includes technology solutions that can not only be applied to financial services, but across any sort of sector. One key area of growth, apart from the whole AI space, is on the topic of cybersecurity. We're seeing increased adoption of fintech solutions across corporates and also financial institutions, and the rise of cyber attacks has also been sort of increasing year over year. So I think cybersecurity remains very critical and often overlooked sort of aspect within the venture capital space. The other area of growth that we also see will be on the whole emerging markets landscape piece, such as Southeast Asia, MENA, LATAM. I think we're looking at this area as a form of portfolio diversification. We also see very favorable factors such as strong digital economies driving demand for digital services like fintech. And within fintech, we're seeing a lot of corporations and also institutions across the whole emerging market space adopting a lot of fintech solutions, which definitely could drive momentum going forward.
Ali, any particular verticals or sectors getting you excited?
So fintech is one of the sectors we tend to love and prefer and focus on. And it's actually one of the highly funded sectors in the MENA region. And this is because of so many things. The first, because of the improved regulations. Whenever you go to most of the countries, especially GCC and also some of the MENA countries, you will find so many sandboxes, whether from the central banks or whether from let's say, the market regulators. This enables so many entrepreneurs to be innovative, to support actually the system by building something that could be viable even to those industries. And since you mentioned AI, I would say that although the AI has been in, let's say, rapid growth, especially in the US market, we haven't seen that yet in the MENA region. We've seen, yes, several deals, but I wouldn't say that all of them, they were like deep kind of AIs or those kind of monetized products.
Jörg and Ekta, what other sectors have they not mentioned? What other areas might be underrated in the VC market right now?
Yeah, I think there's a vast, besides fintech and AI, there's a vast majority of other areas which are important to work for a better future. First of all, the whole life science area with drug development, but also on the technical side, medical technology is a very, very broad sector in itself. And then if you think about education, this is a very important sector as well, which is also affected by AI, of course. Then we have also other sectors which are a higher degree of specialization, but which are very large. Think of prop tech, property tech, the building industry, for example. So there are lots of sectors where innovation is driving the traditional industries and offering a lot of opportunities.
Ekta, each of our other panelists tend to have a regional focus in their investing, but you have a fairly global portfolio from my understanding. Why do you think it's important to have that global reach, and why is that a differentiator for your LPs?
We are the LP. It's a family office fund. However, global because we started to focus purely on technology, and by far we know the breakthrough technology hub has been US. So majority of the portfolio historically has been investing in US. Not that we were not interested in other areas, but when we compare deals, the opportunities that we receive from that geography versus what we receive from here or anywhere else, there's like significant difference. Another thing in the region, we have started to actively invest. Why in recent years? Because now we do see the change in the ecosystem, the quality of deals that we are presented. So it makes the right business case for us to start investing here as well. Again, with the tech focus, with the AI playing a big role and all of that, we still see the most innovative or breakthrough kind of opportunities still coming from the West.
And Jörg, you invest mostly in Europe, I believe with a focus on Germany. Why is that an exciting area for investors right now, especially doing it from the seat of a development bank, which I think is a bit unique?
Yeah, maybe a small correction. We invest across Europe, and so KfW Capital is one of the largest LPs in the asset class European venture. We believe that is a very attractive asset class, venture capital, because Europe in itself is very rich when it comes to technology and intellectual property. We have a lot of outstanding universities and research and development institutes in very, very many areas, and they produce a lot of IP, which is worthwhile investing. Another aspect which I would like to point out is due to the strong regulation which we face in Germany, which is not always a pleasure. We in Germany and in Europe we have a very strong environmental tech sector, and this is something which I think also looking into the future could be an attractive area to invest, because the technical standards on the environmental side and on the climate side, be it CO2 reduction, be it treatment of water, for example, are really world-class standards which we have and could be exported into other parts of the world. And third, another aspect I would like to make is ESG. ESG is really a factor which became very important globally, but especially in Europe and in Germany. And as we see, ESG is certainly a very important tool to reduce risks on the environmental side, on the social side, and also on the governance side. So from an investment perspective, we have a lot of ESG data and ESG implementation in our investment processes. And these data and procedures make better investments. There was today a study published by Morgan Stanley, and they looked at funds which incorporated ESG versus funds which did not incorporate ESG, and they clearly stated that the funds incorporating ESG in their investment processes already showed a better performance than the ones which do not have ESG standards in their investment processes. So those are a couple of reasons which I would like to point out from a European perspective, which is worthwhile to also look into that region.
And Ali, make a similar case for me for Middle Eastern VC. If an investor had a choice, only enough capital to commit to European-focused fund or Middle Eastern-focused fund, why might they choose the Middle East? What factors are at play?
Yeah. So basically, at the beginning, when we first started, we were mainly focusing on the GCC market, Egypt, and Jordan. And after that, we decided to expand it further now in the new fund we're currently raising to be whole MENA. So whatever happened or has been happening actually in European market, in South Asia, and US, it's been really happening in the past 30, in some countries even 40 years. and it just started happening here in the past 5 or 6 years. So it shows exactly the kind of potential that has not been tapped yet in the region, as well as, of course, we want to invest in our own people and developmental of our own countries as well to be dependent. So we do believe that we have the talent, we have the market, we even have whatever it takes to uplift the market. So we will continue to be focused on the MENA region as
I want to turn now and focus on the exit environment, specifically the IPO market, or maybe the lack of liquidity thus far from VC portfolios. A bit of data to illustrate some context here. The average distribution rate, according to our data for VC funds, is about 16% of net asset value every year over the last decade, 16%. And so far this year, we're sitting at just about 5%, so less than a third of the long-term average in terms of distributions back to investors. Ivan, what do you make of this, and how might we turn this around? Is it wholly dependent on the IPO market reopening, or what other avenues might VCs have to generate some liquidity?
So I think on the GP side, there'll definitely be more pressure to generate liquidity in the coming years. I think VCs going out to raise the next fund, over the next few years would definitely experience quite a challenging fundraising environment. I think importantly also the fund strategy will be quite a key differentiator for these funds. On the LP side, I think LPs are definitely becoming more selective in terms of manager selection and also sectors of which they invest in. We'll also start to see a flight towards quality over quantity. But that's it. I think DPI is a lagging indicator and highly dependent on a lot of factors, and the macro environment probably being a very key one. The current environment has definitely extended the timeline to realize returns, I think there's still strong fundamentals in the portfolio that could yield very significant outcomes when the environment gets better. I think importantly, LPs and GPs should be able to adapt to this evolving landscape, and I think a focus on patience and long-term value creation would probably be quite key. Yeah.
DP is a lagging indicator, certainly. Ekta, are you seeing that in your own VC investments, in the fund managers you invest in? Have things started to turn around perhaps before DPI has started to be generated again?
Yes, absolutely. And we already covered the GP point of view. From LP point of view, I would say that yes, when distributions are on the lower side, the direct impact is that cash in hand that I have obviously is less. So I cannot not do what I've already committed. So committed in the past where I'm getting the disbursements now. So that cash is circulating. But when it comes to making new investments or the opportunities right now, the only choice for me in that case is to be conservative. Generally, we do consider 5% of standard deviation when we forecast our own cash flows and allocations for the year. But for example, the data that you're showing right now, it's like huge deviation. If the deviation is beyond 5%, that means the current quarters will have to undergo the changes that are necessary in that period.
Mm-hmm. Ali and Jörg, anything to add on the distribution front? Are you seeing DPI being generated in VC funds? Is this data perhaps wrong? Are there certain pockets where liquidity is easier to find?
I would say it's too early in the region since it has just recently been really started. But talking about ourselves, we have already distributed out from our 2020 vintage fund. So I believe, it's something that it started to happen, but there has been some challenges in some part and a time requirement in the other hand. So most of the fund, they just started around, I would say, 21 or 22, and only those who are very early, they started earlier. So if I will talk about our, let's say, old fund, which started in 2014, and it used to be a corporate fund, so there was no LPs, it was our own balance sheet. We have already distributed the full capital, so the whole DPI had been returned, and we only kept a few opportunities which are strategical positions, honestly.
And turning to fundraising now and the existence of emerging managers, in 2021, there were about 25,000 active VC investors globally. Today, there are about 15,000. There's been a real recession of that tide that has washed away some of those emerging or tourist investors. Jörg, do you think there's still room for emerging managers in addition to the Tiger Globals and the Andreessens and the big players?
Yeah, I think there's not only room for emerging managers, I think there's an urgent need for emerging managers. And I mean, being a sovereign investor, KfW Capital, we are one of the largest LPs in European venture. We see a steady, as we see a deal flow or pipeline of emerging managers coming to the market. Although we had a very tough market in 2022 and 2023, but the pipeline of emerging managers is still active and is coming. I think one important factor for this emerging managers is also the support from the governments. Also, what we see here in the region, but also in Europe and in other parts of the world, that governments really foster the development of fund managers. And I believe emerging managers, if they have a strong individual track record and work together as a team and have really a specialization, a certain know-how, and I think they will always have an edge versus funds which have a broader focus and which are less specialized. So it's really important that we see emerging managers, and we see it happen. In Germany, we have just launched an emerging manager facility, KfW Capital. This is a program where we especially invest in new managers, also gender diverse teams with a certain specialization in various areas. So this emerging manager phenomenon has not stopped, and we are very confident that it will go on.
Ekta, family offices are known for their flexibility in how they're able to approach their asset allocation. Does that affect how you allocate to new emerging managers versus established managers, or how does that flexibility affect who you're allocating to?
Okay, I will have to break the question into two segments. So I have had both the experiences. I would say depending on the strategy of the family office, if it is very risk averse and historically has been just managing or allocating cash in terms of just public equities or bonds, they're going to be very reluctant in going for the first time managers, emerging managers. However, the research and the data also suggest that first fund of all the managers usually outperforms all of their other funds. Now, what makes the other funds' performance goes down needs a separate research, but at KBW, we have backed emerging managers, first-time fund managers, and that doesn't mean that track record doesn't matter. Track record of the GPs matter a lot. And if the GP is starting a fund which is now an emerging or a new fund, it makes sense for us to bet on that. End of the day, it's the team, be it startups or be it funds, it's the team that is responsible for the execution and the success of the project. Yeah.
Ali, let's stay on that theme of track records and how important they can be, and returning to the VC ecosystem here in the Middle East. A record $35 billion was raised in 2023 for PE and VC funds based here in the Middle East. But it's a much newer ecosystem, so there's less of a track record to point to. Has that been a challenge for managers when fundraising here in the region? And then follow-up question, is that capital likely to stay in portfolio companies here in the Middle East, or do you see it being raised and then deployed in portfolio companies elsewhere?
Well, I would say raising capital in the region is, yes, harder than any other region, but I wouldn't say it's impossible, especially if you're a value creator and you already have a track record, you will always be able to, let's say, raise money. The good thing about it is that, with less funding in the ecosystem compared to other market, it will mean that there will be a regularized kind of valuation. So you will be able to acquire a certain, let's say, shareholding weight from each startup at lower ticket size. So it will adjust a little bit. But yes, in the past 2 years, it hasn't been similar to 20 years 21 and 22.
And we've got just a few minutes left. I'll ask each of you to give sort of predictions over the next, call it 12 to 24 months for the VC ecosystem, given your sector or geographic focuses. Ivan, we'll start with you. In just a couple of sentences, what do you expect over the next 12 months? Are we going to get out of this rut? If we have this conversation again a year from now, what will we be talking about?
Yeah, so I think definitely a stabilization of the macro environment would probably be expected. We're all expecting a few additional interest rate cuts going into next year. Hopefully, inflation will also stabilize on a global basis. Lower interest rates essentially benefit valuations broadly, particularly on the public market side, and I think this is slowly showing already on the public markets. And then, as mentioned earlier on, private markets lag the public markets by about 9 to 12 months. So I think the private market should also get better as well in terms of, particularly on the exit valuation sort of environment. I think there's also quite a large backlog of scaled, profitable companies all waiting to go public and all waiting for the IPO markets to open. I think already, signs of gradual recovery given the recent tech listings over the last year shows promising signs. So I think all in all, obviously remaining very bullish on this ecosystem.
Ali, what are your predictions for the next 12 months?
So luckily, VC investors are always optimistic, and this is what has always driven the market up. And no matter how much the market just think, they will always look up, and they will say the market is pretty good. And I think this is very important because after all, this will drive the entrepreneurial spirit across the ecosystem. But I would say that yes, there is a high expectations that the interest rate will just let's say, regularize the market. But on the other hand, there is also disappointment with the effect so far to the inflation and whether they will be able to regularize the market. And this is a $1 million question. But in the region, speaking about, let's say, GCC specifically, I would say that there are so many, although there is some geopolitical tensions, but economically, I could see that there are great things that's happening. Even when we talk about exits in Saudi Arabia, every year so many companies, they go public like there is no tomorrow. This year, I believe more than 60 companies, they went public, out of which some were VC investments. So today, it's not difficult to go public in the Saudi market, especially in the parallel market. Even if the company is not profitable, they could just go public. So I believe this will always, let's say, make the market attractive to other investors.
Jörg, what's your outlook?
My prediction is pretty simple. I think VC will continue to gain weight in the private market asset class. Not only in the next 12 months, but also on the long run. I see that we will have much more information and much more transparency about venture capital investment opportunities, which will attract new investor classes into this market. We will see secondary funds, and we will also see an emergence of venture debt, which is kind of a natural evolutionary process in the capital chain. Following the equity investments. So I see further stabilization and further growth of the whole venture capital market.
Ekta, your predictions?
I'm thinking, what is left now? They said everything. To be very honest, I do see that, or I do believe that we are still gonna get opportunities at slightly lower valuations, and it's gonna take a bit to revive and bounce back to the levels that we have seen in the past. So I expect to see opportunities more, quite a lot in secondaries as well, along with primaries. Good news from investment point of view is that the outrageous valuations that we've seen is that era is gone, so we might get better opportunities actually from the VC front. Overall portfolio allocation wise, yes, I agree that VC is gaining more momentum, and with the limitations that we are seeing on the public market size, of course, there are limited options. Where would you go? If you have to lock in your money, VC is a good alternative. And globally, we have a lot of opportunities and a lot of challenges also. From our risk mitigation point of view, we try to diversify as much as we can. So diversification is one of the keys that everybody is considering, and VC has got good opportunities that way.
I'm sensing lots of optimism, like you would expect from any VC investors worth their salt. Unfortunately, we're out of time. Thank you so much for joining us, and please join me in giving a round of applause to our panelists.